The Dow, 22,000.
I saw this yesterday.
Woo-hoo!
I saw it, and I thought, 22,000? Are you kidding me?
Yeah.
And at the same time, I was reading stories about 6,300 stores so far this year across America have closed up. And we're talking big stores, Sears and Macy's, and the list goes on and on. I don't have time to name them all.
Right. Older brands seem to be going away, but the Dow is at 22,000. What's behind all this? Let's turn to financial strategist Clark Hodges with Hodges Capital. Good morning, Clark.
Good morning, guys. How y'all doing today?
Doing well. What do you make of, first of all, how much should we make of Dow 22,000?
Well, I think it's a big deal. I mean, you look at where the market was. The market's been on a bull market tear since March 9th of 2009. It's been going up. You've got to look at when Trump was elected, where the Dow was, and we've hit 19,000, 20,000, 21,000, and now 22,000 all within his first year, which is very, very impressive. You got to say the market, as it looks forward, likes what it sees. And on the horizon, who knows what's coming, but you got to say the market really loves what's been going on.
Of the points that were gained yesterday, how much of that was Apple?
A lot. I would say without Apple being up as much as it was yesterday, we wouldn't have probably been over 22,000. Now, having said that, we still be at 21.9 something. But because the index is weighted to where as it gets bigger, as a company gets bigger, it becomes a bigger percentage of the index. That is one reason why. One of the arguments we've told people this year is the market's very narrow. There's only a few stocks that have been moving this market. If you look at the S&P 500, there's about 10 stocks you could say make up about 80% of the move in the market this year. So it's a very narrow market. It does need to broaden out for it to keep going, but I do think there are things on the horizon that could broaden out. It doesn't mean I think it's going to always keep going. The month of August is an iffy month in the market. You've got a lot of people in the financial centers, like up in New York, who take their vacation. And the amount of people trading stocks goes down, so you could see gravity pull some of these stocks back down. I wouldn't be surprised at all if in the month of August we had a 3, 4, 5% pullback. Probably be healthy to have something like that.
And the Dow is what I believe it's 30 stocks that are watched, right? 30.
Yeah,
do they change? Or are they always the same?
Well, they do change, but they're very rarely do they change. It's a big deal for them to change. Now, the S&P 500, those stocks can change a little bit more frequently, but it's a big deal. Apple used to not be in the Dow, so it does change every once in a while.
Okay, so whether it's real estate or the stock market, whatever it may be, they always go up and they always come down. Now when this stock market comes down, people use the term crash. Will it crash, or will it be a correction? Should people be worried?
Well, the difference in my mind between a crash and a correction is how fast it moves down. If you have a crash, in my mind, you have a 10% or higher move in a single day or a single couple of days. A correction is more of a several-week thing where it pulls back over several weeks.
Okay.
The thing that people don't recognize, I don't think, about the stock market today is there's not as many companies going public. You can get as much capital as you need being a private company, but never before has it been like that. Most companies go public because they need capital to keep their growth going. So you look at companies like Uber, they've had no problem attracting capital. So if you look at the number of publicly traded stocks today versus 5 and 10 years ago, there's a lot less companies public. So any money coming into the stock market is going into fewer companies. That helps keep the market higher. And another factor that people don't really recognize is think about how many times we've heard corporations say, we're going to buy back some of our own shares.
Right. Yeah.
And that's taking shares off the market. And so if you have less companies public and less shares out there to be traded, it stands to reason that any pullback in the market, and when any kind of buying comes back in, it just goes right back up. And I kind of say that's what we've seen this year.
You know, the stock market is just great. Lots of people making lots of money. On the other side of that, Payless has closed 808 stores. The Limited, 250. Kmart, 210. Michael Kors, J.C. Penney, Macy's, CVS. The list goes on and on. Is this more of companies and businesses not keeping up with the times, or does it have anything to do with the financial markets?
Well, I think it has to do with the retail landscape in general. If you're a company and you're not having a strategy of trying to get at least half of your sales online, then you're probably running into some problems. Retailers that own their own brand, let's say like American Eagle or something like that, where you can't go to Amazon and find an American Eagle T-shirt, they're going to be better off going forward than, companies like a Target, where everything that Target sells, you could go right now and buy on Amazon and have later on today or tomorrow.
All right.
So that's the landscape that they're in. And I think it's just a matter of those stores not keeping up with the changing time.
All right. I think Amazon put in a bid to buy China this morning. I don't know.
And they'll deliver it in
they'll deliver it, yes. Mm-hmm. Yeah. Clark Hodges, is always good to have you on. Thank you, pal. Appreciate it.
Thanks, guys.
645, 1320 WILS. So the stock market is at 22,000, the Dow is. So why are 65% of investment managers saying that it's overvalued? Clark Hodges is with us, financial strategist at HodgesCapital.com. Clark, great to have you here.
Good to be on again. How you doing tonight?
Good. The thought that things are overvalued right now, what do you say to that?
Well, there's definitely parts of the market overvalued. We take a look at the market on an individual company basis. So, you could list a few companies that are overvalued, but you could also list a few companies that are undervalued.
Okay. But does the market seem to move in tandem? Like if things are all going to go down, are pretty much all the stocks going to take a hit?
It does seem like that today versus 10 years ago. You turn on the index, the machine, and it's all up. Mm-hmm. Then that means probably you're going to have an up day. If you turn on the machine, they're all down, that means you're probably going to have a down day. There's no swings during the day because you've got these program selling trades going on to where computer programs are written to say, okay, if this stock goes down or this market goes down a certain percentage, mm-hmm. then you're going to sell, and you're going to sell the indexes. That's 500 stocks. That's all those stocks getting sold, so there's even more selling pressure on it. So it's hard to have a day where it turns back around. So it is very much, it does
just in tandem,
more correlated today.
With the way the market's going, though, why not just go into an index fund nowadays and just ride this enormous wave?
Well, a lot of people do go into index funds, and index and passive investing has grown tremendously over the last 5 years. It's probably doubled over the last 5 years. So every dollar that comes in to a mutual fund and to the stock market, mm-hmm. about 60 or 65 cents of that dollar goes into passive investment, goes into ETFs and those kinds of things. And so it is very, very popular, and the fees are lower.
Okay.
But we come at the market from the angle of we want to beat the market, and we want to have performance that outdoes the market. And our philosophy is, if you want the same return as everybody, buy the same stocks that everybody's buying. Mm-hmm. And so we're an active manager, and that's what we do at Hodges Capital.
Although the Dow is up, 21% since the November election. Is that, what is that about? Where do you feel it's going from here?
Well, it's very surprising to me that it's been this strong all year with all the negative news out there politically. Mm-hmm. And, you got to say that the market looks forward. The market is seeing something it likes. The market's not pricing in a war. The market's not pricing in a president getting impeached. It's pricing in policies that are pro-business, and Obama was very anti-business. And so we're just in an environment where pro-business leaders are in place, and the sentiment is very positive for that. If we get a tax break, that's going to be real positive for corporations, mm-hmm. and they're going to make more money. So that's kind of what I see is that they're just saying, hey, we like the current environment.
And is anything
and there's a lot less regulations, too.
Would anything make you nervous right now in terms of affecting the market?
You know what makes me nervous? The month of August. The month of August is traditionally a low-volume month. A lot of people who manage money go on vacation, they go to the Hamptons, and they just don't work. And so you could have a situation where gravity pulls on these stocks. And one day when you're having a sell-off in the market, you don't have the buyers in there because they're on vacation to drive it back up. So you could have a pullback in the market in the month of August. And I wouldn't be surprised at all if we had a 4 or 5% pullback from here by the end of the month.
Just by the nature of things. But on the whole, you're feeling this is a solid place we're at right now?
The market is very narrow, and what I mean by that, there's a few stocks that are really moving the indexes. The index are weighted, so there's about 3 different companies that are provide the return, over 1,000 points of the return, the movement, the Dow.
It's like Apple, and who else are we talking about?
And Dow, and you would ask me the next
well,
one.
Look, I certainly don't know either. So essentially we're talking about 3 companies that are, so really, is it a skewed view on what's really happening?
Yeah, it is, because there's a lot of companies that aren't moving as much. And so you would like to see the market broaden out and money go into these other names that hadn't moved yet. Good, solid, big companies, they just hadn't gotten the attention, like Facebook and Apple and Netflix and Amazon and those kinds of stocks. I really think it's very narrow, and it needs to broaden out in order for it to really continue.
Clark Hodges, it's HodgesCapital.com, a financial strategist. Clark Hodges on WILS. Thank you, Clark.
Thank you. Good talking.
Yep, enjoy. Thank you, Clark.